Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Mitch Bollinger, who's an independent quantitative researcher and consultant that focuses on the real estate sector. Mitch, welcome.
Oh, thanks for having me, Alex.
So I thought today we would start with a paper that you wrote, I think it was last year, called Another Look at Private Real Estate Returns by Strategy, that was in the Journal of Portfolio Management, to give people a bit of a background in some of the work that you've been looking at.
Sure. I can give you the background on that. I actually partnered with Professor Joe Pagliari at the University of Chicago. And how I came to do this paper with Joe is that I was working as a head of research as a consulting firm. And this was a bit of a new role for me. We went to talk to a client. They asked, what we thought about core versus value add and opportunistic funds. And for those not familiar, in the US, you have private real estate funds that are generally put into three buckets. You would have the core funds, which are generally levered in the 20% range. They're open-end, infinite life vehicles. And then you have value add funds, which invest in properties that have less stable cash flows. So maybe they have some lease-up issues or other issues that make the cash flows less stable than core assets. These are closed-end vehicles, finite life vehicles, generally levered in the mid 50% range. And then there's opportunistic funds, which are they invest in assets that have the least amount of certainty in their future cash flows, which could include development projects. Let's say you buy an empty building that all the tenants have gone, maybe it went back to the bank or something like that. And those funds generally are levered in the 65% range, and they are also closed-end. When I say closed-end, it means that investors pool their money to invest in this investment vehicle. The manager goes out and buys these buildings, moves to stabilize them. It's maybe 5 to 10 years, and each fund's different. But then when the properties are sold, the proceeds from the sale are then sent back to the investors. So that was the open-ended question that I was given to say, okay, well, how do we think about core versus value add and opportunistic funds? And in his paper that Professor Pagliari had done, he employed a methodology where he said, okay, we want to think about alpha. We want to think about risk-adjusted return. So then how do we do sort of an apples-to-apples comparison? Well, he built a model that modeled core funds. And with that model, you could then just lever up these funds higher than they were organically. So if they are organically levered in a low 20% range, you can build a model and say, okay, well, what if they were levered in the 40 or 50 or 60% range? And what he did with his methodology is he found a level of leverage such that the equity had identical volatility to value add funds and opportunistic funds, therefore moving to risk parity with to make that comparison. And once you're at risk parity, then you just measure the difference in nominal returns. That ends up being your alpha. Well, the problem that Joe ran into with that first study is that the data set ran into the great financial crisis, and a lot of the funds that were self-reporting, they just stopped reporting. So it was really impossible to tell how much, what the returns were, because you just had a bunch of funds that stopped reporting. So, did they send all of their money back to the investors? Did they send none of it back? It's really not possible to know. But the methodology made a tremendous amount of sense to me. So what ended up happening is I came across a data set called Burgess, and it's an institutional quality data set that tracks, I believe it's about 125 billion in value add and opportunistic funds, and it didn't have these survivorship bias issues that the initial data set did. So I reached out to Joe and I said, hey, Joe, what do you think about working on a paper that's a follow-up to what you did using a similar methodology, but instead we use a much better data set and see if we can really zero in on how these funds have performed. Well, after going through and working the numbers out, what we found is from the year 2000 to 2017 inclusive, so an 18-year time period, these non-core funds had generated alphas of right around negative 3% annually for 18 years, which is certainly not good. One of the things that we drew light to that I'm not sure if a lot of people realize in the private real estate industry is we could quantify the risk, the difference in risk taking between them. So for instance, value add funds had taken 75% more systemic risk than core funds, and opportunistic funds had taken 110% more systemic risk. Or, in finance terms, you would say that they had a beta of 1.75 or a beta of 2.1. And so when you make those adjustments, what you found is that investors were very much not getting a decent return for the unit of risk they were taking. Then we took that a step further, and we have that 18-year period, and we looked at a bunch of different sub-periods, every sub-period down to 5 years. And we said, okay, is it possible that you could have timed these markets? Could you have gotten into value add or opportunistic funds? If you got in 2000 and got out by 2007, could you have gotten a positive alpha? And the answer is also no. And it's very compelling. It's I would say we applied statistical methodology to it and showed that there is a statistically significant difference in alpha. And it's very persistent over time. What we found is you couldn't time the market. So that's sort of a quick overview of what we did with that. And the takeaway is that investors would have been much better off either using external leverage to lever up core funds, or possibly there's been the advent of these other funds called Core Plus, which, while there's not a central definition, generally the accepted definition is they're just like core funds, with the only difference being is that they use higher levels of leverage. And there's numerous institutional funds run by, I would say, large, very credible institutions that are running these Core Plus funds.
So let me put a challenge out there for some of the core funds. You obviously look at the core fund as the basis for risk, and then you sort of use that as the comparative measure. Is there a chance that some of the volatility that sits in the core funds is maybe a little bit lower than it should be? Is that maybe why, when you extrapolate that volatility out, that the core funds look like they have low volatility, but maybe it's because there's a lot of money flowing into them, they don't have the volatility in prices, and so risk is maybe potentially downweighted?
Well, we can get into the weeds a little bit of this, but here's the way that I would interpret it. So unlike traded assets where you have a market that's, you have continuous liquidity, price discovery. For traded assets, and specifically for real estate, you have what they call appraisal valuations. And what that tends to do is smooth out returns in comparison to traded markets. For open-ended funds, they generally provide quarterly liquidity, so there's a process by which they can figure out what the net asset value of all the investment positions are. Now, for value-added opportunistic funds, you don't have as much, you don't have that quarterly liquidity, so their price discovery mechanism is not as good as the core funds with the that have the appraisals, but they're certainly similar in the fact that they're not traded. And I would say that, I'm not sure if there's a very material difference in how they're measured, and if, there's an understatement of risk for core funds. And I could take this a step further, and when you look at sort of traditional finance and you think about beta, you're not looking at total risk, you're looking at systemic risk. And what this assumes is that you're only getting compensated as an investor for the systemic risk that each of these assets or these funds are taking, which means that it's sort of the underlying assumption that any investor is going to own a basket of these, such that they're going to effectively diversify away any of the idiosyncratic risk or the risk associated with with any one individual fund. And what we see is that the total risk of non-core funds, the value-add and opportunistic, that component of the idiosyncratic risk is much higher for those. So, if anything, I would argue that it's probably the other way around. If risk is undermeasured, it would be undermeasured for value-add and opportunistic funds for investors who may not have sufficient diversity across numerous of these funds to really effectively diversify away all that idiosyncratic risk. So, if I had to guess, I would say if there was anything, the alphas would probably be even worse because of that idiosyncratic risk.
Let me throw one more question in on that risk piece, and that is to value add and opportunistic. You sort of touched on it at the start, is that core funds drive most of their returns through income, and value add and opportunistic draw most of their returns from that change in the value that comes from it, and then income comes later. Is that another potential reason, or how is that addressed in the paper?
With the data set we have, we can't bifurcate total returns for value-added opportunistic funds into income versus capital returns. And my take on it is, investors should be looking for total returns, and they should really be independent, whether they come from capital gains or income returns. And that may be something that someone wants to look into, but sort of in my mind, it doesn't really matter if investors should be focused on, total returns.
Mm-hmm. So, if there is this research that's out there, and there's a lot of consultants work in this space, particularly obviously in the US and Australia too. Why is there still such this demand for these sectors if the returns aren't adding up and they're not generating alpha?
Well, what I've observed in the industry, and a little bit more background on me, I'm both a CFA charter holder and a CAIA charter holder, and you have a fiduciary duty to your clients. And if you dig into fiduciary duty and really define it, it's fiduciaries need to consider both risk and return. And the most prominent return metric used in the private real estate industry, certainly in the closed-end funds, is IRR. But IRR has no concept of either a market to benchmark against or a concept of risk. Yet, this is it. What people seem to think, value is, and investors agree to pay over an IRR hurdle rate all the time, and by implication, that sort of implies that they think it's value, and it's not. And there's no shortage of academic studies to say, hey, listen, this is really not what you should be looking for. And if I can give you a quick, sort of a little thought piece on why that is let's say you're invested in a fund that's levered 75%, and things for the last 8 years or so, you would have done really well at asset prices have much higher returns than the cost of debt. But then if you run into something like the great financial crisis, you maybe instead of, a core fund will draw down 35% but you took so much more risk, maybe you're down 80%, and that can wipe out 8 years of, otherwise good performance. And if you were paying for, above an IRR hurdle rate for those 8 years, you paid big fees to the manager, but then in the last year, then, you lose 80 or 90% of it. If you look at that return over the whole period, you're not doing that great. You do feel good for those 8 years. But that's why as fiduciaries, you're supposed to be looking at both risk and return. I think it's just so ingrained in the industry. There's a dearth of, CFA charter holders there. And to the credit of real estate people, if you come from a development background or a real estate asset management background, you don't need that level of financial sophistication. But I think the problem you run into is that when a lot of people come up to the real estate industry through an asset management background or some other, some other background, then they start making these financial decisions. They may not have the financial tools and knowledge available to do their job effectively. And that's what we see from a top-down standpoint, is that investors are paying gigantic fees for very negative alpha. And if we dig into the fees specifically that we saw in our paper, we saw over that 18-year period, core funds were paying about 1% of invested assets, 1% of equity a year, versus value add is paying about 3%, and opportunistic's paying 4%. So you have these non-core funds that are performing at you're paying 3 to 4 times as much for fees, whereas you would have been dramatically better off had you just invested in a core fund, paying that lower fee, and just applied more leverage to it. But like I said, I think it's so ingrained in the industry, and you do have to be financially sophisticated and quantitatively sophisticated to be able to diagnose this shortcoming and see what's and see why you've had this poor return. And I'm just not sure you have that level of sophistication throughout the industry.
Let's maybe stick to the fees part of the conversation. Is there a way that you can suggest that you can sort of map the fees that should be paid alongside performance? Is there any suggestions that you have there in terms of what investors, fiduciaries should be looking at as they think about the fees they're paying for these types of investments?
Yeah, and I think this is a good way to talk about it. Those negative alphas, those very large negative and persistent alphas for non-core funds, if the fees were at parity with the core funds, around 1%, there wouldn't be a material difference in alphas between core and non-core. So really, the root of the problem is the fees. And again, what you see is that investors are agreeing to pay for over an IRR hurdle, which is not alpha. And in business school, they would tell you should never be paying for beta. You should be paying for alpha. But that's exactly what's been happening. So I think one of the shortcomings of the industry is, and this isn't just real estate PE, it's PE in general, to figure out how do we make a reasonable estimate of what alpha is. And actually, I'm working with Joe Pagliari. I have a draft paper written on a methodology that I would think is a best practices for doing this. It's sort of a combination of what we did in our paper and the direct alpha PME methodology. And if it measures alpha, and then if you agree, or if an investor say, hey, listen, we are absolutely willing to pay for performance, but we don't want to pay for IRR, because you're not supposed to pay for IRR. Anybody can go out and just lever up a property, and if cap rates compress, as they have in the last 8 years, you can do well. So you may not, and it's oftentimes you are not creating value as defined as alpha. But if you change the compensation agreements to say, what we're going to do, we're going to change it. So instead of we pay over an IRR hurdle, here's the methodology by which we're going to calculate alpha. And if you do generate positive alpha, we'll be glad to split it with you, to incentivize the managers to actually create alpha. But what it does is it also incorporates a market-based benchmark and adjusts for risk. And this is sort of what is beyond me a little bit, is that this is what fiduciaries should be doing all day, and they're not. And even what you see with the paper that Joe and I have written, it's published in the most prestigious research journal for real estate. I think you can certainly make an argument that it's sort of the go-to journal for real estate. And you're seeing consultants who won't even reference this study. They won't even, they won't even count as that it exists. This is like I would say at the foremost of industry thought on core versus value add. And I've heard it explained to me. I said, our clients don't want risk adjusted returns. They just want returns, which, as an example I used earlier, that can work great if asset prices are going up as they have in the last 8 years or so. You feel pretty good, you're making some real good returns. But then something like the great financial crisis comes along, and you could end up like CalPERS, where they had a 70% peak to trough drawdown in their portfolio. It's it's I think the irony of this, or the way sort of I like to think of it, is in order to get good long-term nominal returns, you need to think risk-adjusted returns in the short term, and I think there's certainly ways to do it, and I think investors should demand that you just say, hey, listen, we're not going to pay for IRR anymore. We're glad to pay for alpha, and we're glad to pay for performance, but we need to be true to our fiduciary standard and consider both risk and reward.
Mm-hmm. Let's go back to, you talked about sort of a benchmark, and obviously Odyssey's used a lot for the core. Is that benchmark still appropriate for a lot of the core funds, and then using that to extrapolate out from a risk perspective?
Well, I can talk in the U.S., but I think anywhere else in the world, you generally have similar type benchmarks, and I can sort of talk about the methodology I think is reasonable to use in the U.S. So the Odyssey is a core fund index. I believe it now. Maybe it has 25 funds in it. Sometimes they put some in, sometimes they take them out. But I think the total aggregate equity is about 210 billion. Now that's tied in with the NACREIF, National Council of Real Estate Investment Fiduciaries, and the NACREIF also has an index they call the NACREIF Property Index, which tracks, I believe, like 650 billion in generally stabilized, core property types that are owned on behalf of institutions in the fiduciary environment. And what's really nice about that data set is that you can query it and say, okay, give me all the apartments, give me all the industrial, give me all this, or give me all the properties in New York City or something like that. And you can really do a custom query and really sort of customize it to what you're doing. So I would argue the most reasonable way to benchmark a private fund, especially a closed-end fund, is, let's say you have a fund that's, all right, we're all across the U.S. and we invest only in industrial properties. Well, then you would say, okay, well, we're going to query the NACREIF and we're just, okay, just give us industrial properties. In which case that would then it adjusts for the property type. And certainly, I mean, there's not one right answer for this, but at least adjusting for property type is a big step forward, I think makes a lot of sense. And then what you could do, you can adjust for risk and say, all right, well, this fund was levered at 55%, and we think something that was going to be at risk parity should be also at 55%. And then what you can do is you can use sort of like a direct alpha method on that risk parity portfolio you created. And there's, a lot of different things you could do to it. And with, no need to get into the details on it, but you're just thinking of what's a reasonable and defendable way to try and think of alpha. And, remember, currently what's being used is like IRR and return multiples that have no concept of either risk or market. So you're not starting with something that's a great solution. You're starting with metrics that, are basically inappropriate for fiduciary use because they don't consider either the market or risk. And, that's, and Joe and I are, working together to put something out, and hopefully with any luck, we may be able to put something out that is sort of the best practices. And, I'd say there's not a magic bullet for any of this, but what we're shooting for is reasonable and defendable. And, I think if everyone gets on the same page of like, hey, listen, IRR is not value. We need to all sort of come to agreement on this, and then from there you can say, all right, well, what are reasonable ways to move forward and think about this, and what should they be paying for? And I think that's we're trying to help the industry move forward in terms of increasing their financial sophistication.
So, if you think about from an investor standpoint, what they are trying to solve for, they're trying to solve for returns, and getting member outcomes ultimately. So they're under a huge amount of pressure to find returns, and fixed interest is really challenged. So they're looking to real estate as a potential way to capture that income. As more and more funds allocate money to real estate as an income source, what are the pushbacks that you're getting as they start to say, well, hold on, this is the best opportunity for return for us, and almost risk is becoming a bit of a secondary thought. Is that a fair way to think about it, or?
Well, if you think about a formalized investment process, you would start with investment policy statement, and then you would have to figure out, you as an institution or an individual, you'd say, okay, what is our risk tolerance? Can we sustain losing 80% of our money once every 8 years? No, we can't. So then what's a reasonable level of risk that we can take? And again, these are all trade-offs, but I think it helps to start with risk tolerance. And I think a concern that I have is a lot of pensions in the US, and I think all over the world, they may say, all right, listen, we have a 7% risk return hurdle, so that's what we need. It's either we get that or we go bust. So then they can just sort of solve for leverage. But if you think of this in terms of like a normal curve, you say, okay, we live in a world where one of two things happen: either things go good or things go badly. And if you take let's say you're in a core fund and things go badly, you say, okay, well, we're down 15%. Boy, that's bad. That's our bad. But if you then lever it up to 65 or 70% and things go badly, you say, well, now we're down 35%. And again, it's, if you look for the great financial crisis, core funds, I believe, were down 35%. So just the back of the envelope, if you're an opportunistic fund and they are taking, we estimate historically, or at least, we actually calculated that the beta was around 2.1. So if core funds are down 35% and any, funds that have a beta of 2.1 are going to be down over 70%. So, these are what investors have to ask themselves and really think through what their risk tolerance is. My perception, what I've seen is, they sort of call it like a swing for the fences. It's like 7% or die. And, we've certainly seen a global a pandemic, and, at some point, we'll see how this all works its way out. Frankly, in the U.S., we're looking at an annualized GDP drawdown of around 52% in the second quarter of 2020. I would say that asset prices are holding up pretty well, considering that, that basically is one quarter saying that GDP in the U.S. is looking at it's going to be down over 13%. You compare that to the GFC, peak to trough, we're down a little over 5%. For instance, traded REITs we're off 70% peak to trough the last go around, and we're looking at a GDP drawdown that's going to be 2.5 times what it was last time. So in the big scheme of things, I'd say asset prices are holding up exceptionally well in the light of what's happening of the economy. But like I said, for investors, I think they need to really put a bunch of thought into what the risk tolerance is, and then also have I think a key is knowing what you don't know. Nobody could have seen this pandemic coming, and there's so much uncertainty out there. And no one ever sees a recession coming. No one ever invests expecting to lose money, but we certainly know on occasion they do lose money. And it's just sort of being able to think abstractly like that and using history as a guide to really sort of think across the spectrum of outcomes and to say, and really think on the downside, which it's got to be challenging to be a pension manager. So, well, we need to catch up. All right, well, we'll just take a ton of risk. But even with the paper that Joe and I wrote, you say, okay, well, that's a completely separate decision. Here's the amount of risk we want to take. The paper Joe and I wrote said, all right, well, here's how to get the most return for that amount of risk you're taking, and it would just be whether investing in core plus funds that are levered in the 40 or 50% range, or institutions can do really interesting things if they're flexible to say, okay, well, we want to invest in we're going to actually invest in a 20% levered fund, but let's say our real estate allocation is 10%, but we also have a bond allocation. So what we could do, we could actually invest 12 or 13% in real estate, and then transfer price that estimated cost of of corporate debt back between the two, and they could do that in a low cost way, and essentially synthetically lever up real estate. And I know that's out of the comfort zone of a lot of institutions who have these big buckets, but really from a from a mathematical standpoint, it's essentially doing the same thing. And I think really thinking return per unit of risk. There's a reason why they teach that in business school. There's a reason why there's Nobel Prizes given out for that. It's because it makes a tremendous amount of sense. And like I said, for pension funds, a lot of them are underfunded, and actually the interesting thing about, if you go through the CFA materials and you talk about risk tolerance, they would argue is that the more underfunded you are, you have a less ability to take losses, because you don't want to, you think it's like, in gambling, it's double down. Okay, we're 50% funded, but either we're gonna get back to 100, or we're gonna lose it all. And you would think institutions want to make sure that's especially not the bet that they're making. They don't want to make it any worse, but I'm not sure if that's happening. What I've seen is there's been a big rush to opportunistic funds in the last couple of years, and we'll see how it shakes out.
Mm-hmm. Let's take it back. You sort of touched on REITs there for a moment, and you talk a lot about beta, and beta being the place to sort of adjust for risk for some of the private space. Does it make sense that a lot of these pension funds ultimately then are within the REITs space, to make sure that risk is appropriately calculated and they can get a better understanding of performance? Is that what you're trying to suggest as well?
Well, certainly in the paper, we didn't open it up to REITs, and people in real estate always, they don't like this conversation. But my argument, if Andrew Ang, who is a tenured professor at Columbia, wrote a paper, I believe it was called In Search of a Common Factor for Real Estate, where he went through and said, oh yeah, basically the same thing's happening in public and private real estate. The only difference is the price discovery mechanism. I would argue that there's a tremendous amount of data and information being generated in the publicly traded REIT market that investors could use in the private REIT market, the private real estate market, to help inform their decision making. And actually, I did some work for Vanguard, where I helped them understand or how to consider private real estate in a portfolio of traded assets, in terms of how do you do an apples to apples comparison for risk when you have traded assets and non-traded assets. And I think there's reasonable quantitative ways you can do it. And certainly there's been academic work on it. You just need to apply it. And but it's per Andrew Ang's paper, it's fundamentally it's the same factor in his view of the world. If you think of factors, investment world from a factor standpoint. But yeah, there's I think it helps to all look at it together, and there's a tremendous amount of data and information that you can glean from the public markets to think of private markets, and from the private markets to think of public markets. The more that you think of it as one integrated market, I think the better off you're going to be in terms of decision making.
All right. So final question, and this sort of comes back to sort of what's been the conversations that you've had with investors and maybe consultants about this paper. What's been maybe the pushback that you've received, and sort of concerns about what you've raised?
Well, I presented this paper to the NACREIF research committee in Miami last fall, and Joe actually presented it to a large group out in California. And I'd say, in summary, no, they're not buying it, right? The whole idea of IRR just being that's what value is, and this idea of alpha being what value is, that's sort of like, oh, it's a bunch of academics talking about stuff. They don't know real estate, and they're it's not pertinent, it doesn't really work. And then you would say, well, but the traded REITs, where you have a price discovery mechanism where you can use the measured volatility of price return as a reasonable proxy for risk, and you can apply your sort of historical, I would say more mainstream type analytical tools for it. Over that same study period, 2000 to 2017, traded REITs tremendously outperformed the indexes of core value added and opportunistic funds. And essentially they're doing, the biggest reason for it is they're doing exactly what our paper suggested investors should have been doing all along. It's applying more leverage to stabilized properties and paying a fee, an asset management fee, and for traded REITs, it's a G&A fee instead, but it's essentially the same thing. Is paying a similar fee to what you pay for core funds, and so REITs over that same period were levered average about 44%, core funds about 22%, and core funds, REITs outperformed core funds by a nominal 4% a year. They outperformed value add by about 3.5% a year, and they outperformed opportunistic funds by about 2% a year. But the thing is when you get down to the asset level returns, and especially when you normalize for asset type, there's not a material difference between the performance of the assets owned in core funds and traded REITs. And actually, Professor Pagliari had also done some work on that, and I'd sort of built on that some with some other data sets and essentially came to the same conclusion. So, when some people look at our paper and say, oh, it's all theoretical, and I say, well, certainly there is some theory applied, but sitting parallel to all this private real estate the whole time is the public market, which essentially did exactly what our paper suggests investors should have been doing, and just applying more leverage to core funds, and they really did dramatically outperform. And you think about that, this was 4% outperform over 20 years. You do the math on, I guess it's 18 years, but 4% outperformance over 18 years, that really moves the needle on what your portfolio looks like after 18 years. But there's no reason why private real estate funds couldn't get that same level of performance as the traded REITs have, but they just need to start thinking alpha instead of IRR. They need to change what they think of what value is. Value is alpha, value is not IRR.
Mm-hmm. Well, that's a fantastic place to leave it. Thank you very much for your time today, Mitch.
Oh, thank you.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.